Okay, let's be real. We've all heard that real estate is one of the best ways to build wealth, right? We all dream of collecting those monthly rent checks. But the reality? Well, the reality of being a landlord with all the headaches that come with it, that can feel like a massive hurdle. So how do you get the income without all the drama? I mean, that's the big question, isn't it? How do you tap into all that real estate income without getting that dreaded midnight call about a burst pipe? Well, it turns out there are two very different ways to get it done. So for anyone starting out right now in 2026, the real estate world basically splits into two main paths. On one side, you've got something called REIT, that's REIT for Real Estate Investment Trusts. And on the other side, you have the good old traditional route of buying a physical rental property. Both can build wealth for sure, but the journey on each path totally different. All right, so let's break down what these two options actually are. Think of it like this. Either way, you're investing in the same asset class, property. But the choice you make is going to have completely different consequences, not just for your bank account, but for your free time too. Okay, first up, let's talk about REITs. So a real estate investment trust is basically a massive company that owns and operates a whole portfolio of income-producing properties. We're talking apartment complexes, shopping malls, even giant data centers. And here's the really cool part. You can buy a tiny little piece of that company right on the stock market, just as easily as you'd buy a share of, say, Apple, and then you've got the classic rental property. This is what everybody thinks of, right? You buy a house or a condo, you find some tenants and you collect the rent. But here's the key difference, and it is a big one. You're not just a passive investor here. No way. You are the CEO, you're the handyman, and you're the customer service department for your very own small business. Okay, so how in the world do you choose between these two? Well, we're going to compare them head to head across four really crucial factors that every single beginner needs to think about. Let's dive into the breakdown. First up, and for a lot of us, this is the big one. How much money does it actually take to get started, and how easy is it to, do it? And wow, just look at the staggering difference here. On the one hand, you can start investing in a diversified REIT for what, maybe $50? But on the other hand, for a physical rental in 2026, you're looking at an $80,000 mountain of a down payment plus closing costs, plus cash reserves. I mean, we are talking about two completely different financial universes here. So yeah, in our first round, it's not even a contest. When it comes to cost and just how easy it is to get in the game, REITs take the trophy hands down. It is without a doubt the easiest way for a beginner to get a foot in the real estate door. So REITs are way easier to get into, we've established that. But what about the payoff? Let's talk about what really matters, the returns and the kind of income you can actually expect from each of these. Now this is where the comparison gets really interesting. You see, REITs typically pay out a pretty steady dividend. We're talking in the 3 to 4% range, and on top of that, the value of your shares can grow over time. Rentals, though, they can offer a much higher cash-on-cash return. That's the annual profit you make on the actual cash you put in. And it can often hit 8 to 12% on a good property. So just looking at the numbers, it seems like rentals have a bigger upside. But, and listen, this is a huge but, that higher return comes with a whole lot of ifs. Your actual profit depends entirely on choosing the right market, your ability to raise rents without scaring tenants away, avoiding those catastrophic repair bills, and honestly, your skill as a manager. It is absolutely not guaranteed. Right, those higher potential returns from a rental property, they don't just appear out of thin air. They come at the cost of your time and your energy. And that brings us to our third comparison, the actual effort involved. This one is all about your lifestyle. Okay, here's the core difference in a nutshell. Investing in REITs is for all intents and purposes completely passive. You click buy and you're done. No tenants, no toilets, no turmoil. Owning a rental, on the other hand, gives you total control, which sounds awesome, but it also means you have total responsibility when things, and trust me, they will, inevitably go wrong. And this is the question you really have to ask yourself and be honest about it. Do you want passive income, or are you really signing up for a second job? Because that's the real trade-off right there. All right, last comparison. Let's talk about risk. What could possibly go wrong? And maybe more importantly, how quickly can you get your money back if you suddenly need it? You know, both of these paths have risks, but they are completely different kinds of risks. REITs, they move with the stock market, so you've got market volatility and you have to worry about interest rates. Rentals, though, they have those more gut-wrenching real-world risks. A tenant who just stops paying rent, a sudden vacancy that kills your cash flow, a flooded basement. But here's the absolute most critical difference. You can sell your REIT shares with one single click. Selling a house? That can be a month-long stressful ordeal. So here's maybe the simplest way to think about it. REITs are liquid. Your money flows like cash from a tap. It's accessible. Rentals, on the other hand, are lumpy and solid, kind of like a rock. Your capital is locked up in a physical asset that you just can't turn back into cash easily. Okay, so putting this all together, what does this actually mean for you as a beginner right now in 2026? Let's boil this all down into a clear, actionable game plan. You know, the current market environment is absolutely key here. REITs give you instant diversification into hot sectors like industrial properties or data centers. Meanwhile, owning physical rentals has just got tougher. You're facing rising insurance costs, higher taxes, and more regulations. Honestly, this landscape really favors the seasoned pros, not the first-timers. So with that in mind, here's our playbook. It's a low-risk approach in 3 simple steps. Number 1, start small with REITs. This lets you build up some capital and really learn the market's rhythms from a safe distance. Number 2, while you're doing that, pay attention. Understand how real estate behaves without putting a huge chunk of your life savings at risk. And then, and only then, if you still have that landlord itch, you can move to step 3. Expand by adding a physical rental. But now you're doing it from a position of strength and knowledge. Let's boil it down to its simplest form. If you're a beginner and you want a hands-off investment to get started in real estate, REITs are your answer. If you're an active investor who's ready to roll up your sleeves and run a business, then a rental might be for you. And you know that really is the ultimate takeaway here. There's no single best choice, there's only the choice that's best for you right now. It all comes down to how much capital you have, your personality, and exactly where you are on your own financial journey. So I'll leave you with this to think about. Now that you've seen the full breakdown, the cost, the returns, the effort, and the risk, which path are you going to choose to build your real estate future in 2026?